We are going over some trade examples of this 1 minute trading strategy. The student made $1,236 for a month by having 19 losing trades. That means the trader lost more and only 13 winning trades. And the main reason is the risk reward ratio. That means about maybe it's a $2,000, a $3,000, a $5,000 account. When using $100 in the equation, how to make $500 for each time it works out. That means even though when having 10 losing trades and having only 3 winning trades, if each losing trade has an average of $100, but the 3 winning trades have an average of $500, we still make $500 of money. So we're going into the trade examples, and we use the 1 minute chart trading futures, the S&P 500. The main reason is because this market is very consistent in the moves. And there are these 3 characteristics. So if you have something to write down, compare them with your trades. And I guarantee you, literally, you will see that these trades are more running in one direction. Most directions, most pushes you see from here to there, they take about 45 minutes to 1.5 hours. And the thing is, if you have a 5-minute chart, you only have 12 candles within 1 hour. Usually somebody who's experienced is giving the beginner a 5-minute chart because he says you only have 12 candles and the chance is more higher if you trade the green candle that it will more work than if you use a 1-minute chart because you have 60 candles within 1 hour. But the solution to this are going into these 3 criteria that I'm going to give to you if you have a 1-minute chart, because we can decrease the trading signals by only trading color switches, and they're also going to be extremely powerful. That means a red and a green candle for trading up and a green and a red candle for trading down. These 3 things, these 3 criteria to have less losing trades are literally when the market is going out of a no trading area. A no trading area is if you have a lot of candles on the bottom side for trading up, as you can see here, because when the market is wiggling around, this is where money making is literally harder to do. What is more nicer is if the market is clearly structuring up. I'm going to do a buying example. For the selling example, it's the same. So we want to see that the market is structuring higher. We want to see that the market starts to make more green than red candles. Here you can see it's pretty equal. And then starting here, you see more green than red candles. Starting here, you see more green than red candles here. In the second and the third and the fourth circle, you can see that the market is structuring higher. There's more green than red candles. And what the market also starts to do, the market starts to make a more dominant side. In the buying side, you can see here the moves up are more longer in length than the moves down, as you can see here. The moves down are around like 30% of the moves down here in average, as you see here. So if you see that the moves up are more longer, it shows, and a lot of green candles, more green than red candles, using a 1-minute chart, and the market is structuring higher, it shows us literally that the market wants to go up. Another feature, what is also very nice, if the market starts to make more candles higher than lower. Check this out. Here there's less candles. Here it starts to make more candles, and here even more candles. That means people want to trade on the higher side, which shows us that the market is clearly wanting to go up. When you identify one of these 3 things that are fitting, you always have 3 things in combination, one of these 4 things that I was saying, then we use always a medium or a bigger structure high to aim at. That means you can see on the left side, this is the bigger structure high, but very often, sometimes the market is not going there, so we use smaller structure highs. That means each color switch you see on the left side. We're not going for red, green, we're going for green, red when the market goes up. We're going for red, green when the market goes down, and green, red when the market goes up. That means you can see here green, red here, you can see green, red here, you can see green, red here. The difference between the second green red here, check this out, it was being touched by the 3rd circle, so it's not going to be active anymore. What we're going to use is green red, and the highest wick is here, and this is where the blue line is coming from. Green red here, the highest wick is here, and this is where the blue line is coming from. Now check this out. When we see that the market is going up, the market will aim for these blue lines here. So for the medium or biggest structure highs here. So when seeing that the market is structuring higher, we take any red and green candle that we like by having enough experience seeing it over and over again. And when adjusting here, $100 within the color switch, stop placement on the color switch, we buy so much that when the market goes against us to our color switch at the bottom, that it's going to be $100 US. If the market goes up, each same length based from entry to stop, from entry to up in the opposite direction is going to be here $100, $200, $300, $400, $500. You can see this would be a $500 trade, for example, trading up. This would be a $300, $400 trade trading to our first area, right? This would be like a $700 trade trading up here to T1 to this blue line here, as you see here. And the thing is, it's totally normal to lose money and to get stopped out. The money management is just very important, that when having a red and a green candle and seeing these criteria is then, okay, trading one time, losing, in this case, this trader is adjusting around $30 to $70, depends how the market is running. So the trader is losing $50 for one time, and then you can see a red, green, and then the trader enters the trade and then would make $300, $400. So because if the trader loses $50 a trade, she can lose now 6, 7 times and just loses $300, $350, but would have maybe make $400, $500 for this one trade that would have worked trading up here. Let's go to the next picture here. You can see here, again, the same criteria. The trader starts trading here where this gray line is. The trader stops trading here where this line is. You can see here the market starts to make now more obvious, more green than red candles. You can see that it's very obvious that the market starts more length up than the length down, as you see here in average. Even though here this length down was long, you can see here the length up was 50% way more longer. And this was the main reason why we call this one A1 as only an analysis. We just assumed here, we saw here already that the market is pressing, but the trader was unsure. But here the trader was sure for herself to adjust $50 and to make the $300, $400 trade to get the money down. And keep in mind, it's always important not just to shoot one time. It's important when being stopped out to shoot a second time within a red and a green candle. Please use always a demo account and not real money account. You can do that using TradingView in the beginning to type in US 500 at the top, for example. Because most trading platforms, they cost you $1,000, $2,000. And I think like it's not good to trade. I mean, you have the possibility to use TradingView without paying anything for the trading platform. So you can see here also the goal, also here green and red is here, green and red is here, and here again green and red is here, right? You can find here these green and red color switches, and the highest wick of the color switch, this is where the blue line is coming from. I would have wished also that the trader maybe also draws in here this color switch here, because this is also a medium structure high here, right? Like there should be also a line, but it's not a big deal. And you find here green red again, here green red again, here green red again, here. And this was the main reason why the trader adjusted to $50 to make the $200, $300 trade up here, right? Let's go to the next day. Sometimes you have days also here that the market is of course not going just up, also going down. So you find here more length that the market goes down than up, right? If you just take the up movement, even though this is long, this here was longer. This was the main reason why the trader didn't took A2. This was the main reason why the trader started trading here, adjusts $50 for this trade using the color switch. If the trader would have been stopped out, the trader would have stopped here, would have traded here the next color switch, the green and a red candle. But this trade worked first off, adjusted $50 and made $300, $400 for this trade. So you see here, the market does here a lot of candles, yes, but the market does a lot of length down, more push down, like it does more length down than up. And also very important is now you can find how the market has here these structure lows, medium structure lows here, here, and there, right? Like these are all important. And then you find here the blue line here, what the trader was drawing in here, and then was aiming for this one first with the analysis. That means just like looking, is the market really pushing? And then you find here the other trade. You can find here how the trader, while trading, the trader was drawing this one in, but there's, I don't know what the reason is that it's not in the picture inside, but you can see that the trader was aiming for this one because adjusting $50 and was exiting straight off at the bottom at this low, because you have red and green and the lowest wick is here, right? So let's go to another day, because some days and many days also, sometimes it's going to be 1 or 2 weeks, the trader is going to start here, for example, to trade. Sees that there are a lot of red candles, more moves in length down than up, adjusts $50 and gets stopped out, it's called. Like it's not going in our direction. This really happens, and it's allowed to happen also a lot. This is totally fine. And then you can see how the market is not pushing anymore. How the market does here now, a lot of candles just wiggling around. And this should be starting here at no trading area. We draw this one in like this. And that's already it. I mean, like we have on the bottom side more candles than on the top side. But it's just very dangerous to trade here. The trader saw here opportunity to adjust $50 to make $300, $400, but the trader did not took the trade. And the main reason is because our criteria is When we want to trade up, we want to have more green than red candles, and you could see here clearly before our color switch, we have more red candles than green candles. We have more length down, so the market is pushing too much down, like it's not healthy to trade up. This can work also sometimes when doing that, but the thing is, in day trading, it is all about a portfolio. That means if I have $1,000 divided into 20 trades, I have $50 to trade, and it's always very important to trade always with momentum, that the market wiggles up, does more green than long red candles, is making more moves up in length than the length that where the market is going back. That is also called retracements, if you don't know what retracement means. And is aiming clearly for a bigger structure, medium structure, high or low, or sometimes even consolidation phases if you're a bit more experienced. If the market is going down, for each trade, we want to have more red and green candles. We want to see more length down than length up, as you can see here, and that the market is wiggling down. And maybe you want also to see that the market does more candles down here, as you see here. This is very good to trade here. Each green and red candle, as you see here, each green and red candle would have worked when entering after the red candle closes. Stop placement on the red candle or on the color switch itself, adjusting the $50, and it would go down with a risk reward ratio of 3, 5, or 7, sometimes even 8 or even 15, very rarely. So you can see here also how the market does here less candles here, right? Like in reference from here to here, it does more candles down here. And the more candles are being also lower, you need to imagine, what is very good. If there would be only less candles and it looks always like this, it's not that good to trade. It's hard to trade because they're just going to be very long red candles using a 1-minute chart. But when having here just like a lot of wiggling around and lots of candles lower, we can assume the market is aiming lower, always for a bigger structure low. And this is what this violet line here means at the bottom here, what you see here. But the market didn't make it. So trade number 1 was really good. And then it was also very good that the trader didn't continue to trade. Let's look at another day. Here you can see again, trader starts here to trade. This is what this gray line shows us. And you can see here how the market does here a lot of red candles, goes more down, right? Did also on the bottom side a lot of candles. And now check this out. Here you find a lot of candles. Here you find less candles. And you see now how the market starts to print a lot of green candles. The trader did the trade to sell here, and I think it's okay because you can see here that there are still a lot of red candles. That's totally fine. Now check this out. You can see how the market is going higher, does a lot of candles. Now you find here more green than red candles, almost like a 50-50. And here you can see more green, very obvious, more green than red candles. And first starting here, the trader was able to see that the market is starting to push up, didn't run after the market, it's called mostly FOMO, fear of missing out. The trader was ignoring that. And you can see here how the trader now adjusts $100 or $50 in this case here or here with this stop placement and made her $300 or $250 trade trading up here, aiming for the medium or bigger structure high here to the left, as you can see here or there. And this is all just using a 1-minute chart. There's nothing else included with the trading strategy that I'm giving to you. You can see here more length up, more length up, more length up than the length down. You can see here clearly more green than red candles, starting here especially. The trade just happened here, by the way. Very important because it says here T2, right? And you can see how the market is wiggling higher, and you can see in reference from here to here, you find more candles higher. That doesn't mean you need to trade now in this consolidation area. It means where the market is spiking up and down a lot and we're being stopped out. You can also wait until the market presses out. And maybe if you find in here a lot of green candles, to find a higher quality trade, as you see here. And then it's just all about, even though this trade would have not worked, how many trading opportunities do you have using this cash flow? Because this is maybe a $2,000, $3,000 move. So it's important to have here, you see here red and green, 1, 2, 3, 4, 5, 6, 7, 8 possibilities to adjust $50 to make $200, $300 in average. And this is something that's very important because if you can see all these opportunities, it's not about just to trade with high quality. It is about to take also the trade, because trading with real money also takes some mental strength. Hope you could take something out of this. Have a good one. Wish you all love, good trades. JT out.